Well, good morning, everybody. First of all, thanks to Judy for her kind words. I can tell you I've been dreaming about Wembley and September 2015 for a long time. I was rather hoping I'd be playing in the stadium over there, but the last-minute call-up for the Rugby World Cup didn't come, so thank you for the invitation to speak here on the topic of 2015-16 cocoa supply demand. I spoke in Istanbul at a conference a couple of years ago, and I said that I felt the sustainable price range for cocoa was between £1,800 and £2,200. When I talk about sustainable, I'm really talking about a price at which the farmers in West Africa in particular have the correct incentive to expand production in order to meet supply growth, to meet demand growth in the medium term, and ensure that we don't suffer Laurent's nightmare and run out of cocoa by 2020. The reason that I felt that that was the right price range is that we saw a huge response to the 1,000 CFA price in 2009-10. So prices hit certainly at least 10-year peaks, probably more like 20-year peaks in the harvest of 2009-10, and then in the season following, so 2010-11, we saw a huge supply response, proving, I think, that high prices are indeed the best fertilizer. So, in our perspective, we have a belief that there is clear latent potential in West Africa, that the high price can provide additional stimulus to the farmer, you increase husbandry, you increase fertilizer usage, and you can improve the size of the crop significantly. Looking at today's price, the 14-15 season that we are just about to begin is going to see prices at the 1,000 CFA level for the first time in 5 years. So our belief is that that price level potentially solves the structural deficit, that you see a supply response, potentially that you see a demand response, which we will also talk about, but that effectively farmers through higher inputs can improve yields. If we look at, just coming back to the previous slide, if we look at the expectation at the moment for the 2015-16 season, as we've said, it's set, or is expected to be set at 1,000 CFA in the Ivory Coast. We also believe that basis today's prices, it will be possible to pay the farmers in the Ivory Coast 1,100 or even 1,150 CFA in the 16-17 season. So our view is that the current market is paying the right price incentive. It's not proven yet, but we believe that is the case, and that the structural deficit will be solved in the medium term by this kind of price level. We also believe that there is an uptrend in West Africa. So as you can see, over time, the main crops, the October-March main crop in the Ivory Coast, appears to be growing steadily. If you ask 1,000 cocoa analysts for their estimate of trends, you'll probably get at least 2,000 answers. But overall, I would say there is a consensus that the Ivory Coast is growing in its production capabilities. In Ghana, it's a much more interesting and topical question. We've seen a very disappointing main crop in 2014-15. There are many explanations for that. Some people believe that it is simply an anomalous crop estimate, an anomalous production outturn. Other people believe that it is to do with urban migration from rural areas into the cities. Other people believe that there has been a loss of cocoa acreage due to gold mining and production of other crops. We will only find out for certain as we get the production figures from the 2015-16 harvest. Our view is that that problem is less likely to be a long-term structural issue and more likely to have been a short-term loss of supply. However, we would acknowledge that we cannot be 100% confident. This is a risk going forward. Why do we believe that it is more likely to be the anomalous result? Well, first of all, Of all the people that we've spoken to, I would count at least 8 to 10 pod counting teams who travel every month or 2 months in Ghana. Nobody has yet lost sites or farms to gold mining or to other crops. So it seems very unlikely that we've had a structural loss of acreage which hasn't been picked up by those pod counting teams. If we go forward one slide, I would also just make the point that of the last 4 or 6 crops, if we separate out Ghanaian production into the main crop and the mid crop, we saw very good performance in 2012-13. In 2013-14, we saw close to an all-time record main crop. In 2013-14, we also saw a very strong mid crop. In 2014-15, the crop which is currently finishing, we have seen what we believe to be a pretty good and close to record mid-crop. So the 14-15 main crop, in our mind, continues to stand out as the anomaly. Other people will be discussing this today. We would welcome any discussion or feedback from the attendees today. But one of our assumptions, as we said, is that the Ghana 2014-15 issue is most likely temporary, and we can rebound to higher production in 2015-16. If we move on to look at the mid-crops, I think the trend here in the Ivory Coast in particular is arguably even stronger. 3 of the last 10 years, or really 3 of the last 50 years have seen record mid-crop production in the Ivory Coast. So again, we are pretty optimistic on the long-term mid-crop trend in West Africa. And in Ghana, we didn't see the volatility, we didn't see the low crop in 2014-15, again making us believe that it is possible that we can see a similar or even slightly better mid-crop into 2015-16. With all of that said, growth in production in the Ivory Coast, in Ghana, on a trend basis, would lead the market to a small surplus, a balance or a small surplus in 2015-16. So after the big deficit of 2012-13, relatively balanced supply-demand statistics in 13-14 and 14-15, we believe that current price levels would lead to a similar outcome in 2015-16. However, what we're seeing at the moment, we believe, is not trend production. And that's the key thing to bear in mind. In the medium term, we believe that these price levels provide the type of incentive that will allow the farmers to increase their input usage and balance supply-demand going forward, helping to avert what we've come to describe as Laurent's nightmare by 2020. What we've seen this year has actually been quite an abnormal weather pattern. We decided just to look at the 10-day rainfall in the Ivory Coast just to show how erratic that has been. But if we were to look at Ghanaian rainfall patterns, they would show a similar outline. If we were to look at the patterns between different stations in the Ivory Coast, looking for example at the coastal stations versus the interior stations, again they would show quite different and erratic profiles. We saw quite dry conditions during the end of April and early May, and then in subsequent 10-day periods, the wettest 10-day period in our records, followed by 2 of the driest at the end of May and in early June. Conditions remained relatively dry through July, and with the exception of 1 above normal 10-day period during August, we are now back to very dry conditions. This data was updated as of yesterday. We do not believe there has been any significant change overnight. We're not weather forecasters, but when we look at the current weather forecasts, it doesn't appear as if rainfall will return to normal conditions over the next week or 10 days. So we are seeing a very unusual weather pattern, and particularly dry weather at the moment. So in our view, that is likely to lead to a below trend crop, especially in the Ivory Coast, where pod count development has been less impressive than in Ghana. At the moment, we are forecasting the Ivory Coast crop to be 100,000 tonnes below trend, so at 1.1 million for the main crop against our trend assumption of 1.2 million. However, I would note that several analysts are actually more aggressive with that forecast. There are definitely lower numbers being circulated within the market to the tune, arguably, of an additional 100,000 tonnes, if not perhaps slightly more in some cases. As I've said, in Ghana, we are relatively optimistic that the crop is not in structural decline. That is yet to be proven. Therefore, we are assuming that the main crop can bounce back to levels just slightly below trend at around 600,000 tonnes. However, again, I would make the point, it is currently extremely dry in West Africa. The same is true not only of the Ivory Coast but also Ghana, and that has to be a concern for the development of the later part of the crop. We would also make the case, I think this has probably been widely discussed within the market, that Ecuador is at severe risk during an El Nino season. You can see here Ecuador production going back to the 1980s. We have simply marked the 7 seasons in which we have seen El Nino events. The strong events are marked with the opaque red diamonds. And in strong El Nino events, we've seen production losses of up to 50%. Now, I'm sure a lot of people in the room will say, yes, but the structure of production in Ecuador has changed. We're now dealing with significantly larger amounts of hybrid trees that are stronger, that you won't see the same effect. I would fully agree that a lot of things have changed, but at the same time, this has to be a clear and substantial risk for 2015-16. Our trend forecast would stand at 275,000 tonnes. For the moment, we are penciling in a reduction to 225,000 tonnes. So overall, we see Ivory Coast production around 100,000 tonnes below trend, and as I've said, we are not particularly aggressive with that assumption. In Ghana, we are 25,000 tonnes below our trend number, and in Ecuador, another 50,000 tonnes. So as you can imagine, that potentially turns our trend balance supply-demand into a reasonably significant deficit. The one area, before we get too excited, that we are significantly concerned is on the consumption side. I've been looking at this comparison showing world chocolate sales volumes against world grind for most of this season. And for most of the season, I have been incorrectly assuming that grind prospects would improve and increase to match the associated decline in world chocolate consumption. But actually what appears to be happening is that the chocolate consumption statistics, as they come in, are the ones which are getting worse in order to match the grind data. So I think we will finish the 14-15 season down probably 3.5% on a global grinding basis, and it appears to be something in the region of 2.5% to 3% on a global chocolate sales volume. So that is a clear flag and a clear risk for the 2015-16 balance sheet. We would also note in 2008-9 we had a situation in which inventory destocking and pipeline destocking due to the credit crunch meant that grind performance significantly undershot the reduction in chocolate sales volumes. As a result, in the following year, 2009-10, when the pipeline was restocked, you saw a very strong increase in grind. I'm not saying that that is not possible for 2015-16, but I would say at this stage we remain pretty concerned. If you look at Laurent's slide showing the areas of chocolate demand growth or cocoa usage growth over the last 5 years or so, you can see that it was in many of the emerging markets, so countries like Brazil, India, China, while small, have been significant contributors to global growth. And of course those are the economies that many of us are worried about at this stage. The other thing to say, cocoa butter prices are very expensive, so in both sterling and euro terms we are close to record high pricing. Of course that has an impact on the usage of cocoa butter within confectionery. Of course, it makes it more difficult for the chocolate manufacturers to spend money on advertising and on shelf space rather than protecting margins. And with higher chocolate pricing, you can expect some demand response. So, as I said, I was trying to be balanced. We are very worried about supply this season compared to trend levels, but there are also reasons to be concerned about the standard analyst assumption that we return to long-term trend demand growth in 2015-16. As we said, we've marked down our supply by close to 175,000 tonnes from our trend assessment, and that turns a small statistical surplus into a moderately sized deficit. So we're currently running a deficit of around about 125,000 tonnes for 2015-16. We'll talk in a second about the major risks to that factor or to that deficit, but obviously, as we've mentioned, we are concerned that our supply estimates are less aggressive than many in the market. Other people are writing the crops further down, but we would balance that to an extent by our worry that we may not revert to long-term trend demand growth. If we talk about supply, demand and price, our long-term model here, very similar to, again, to Laurent's slide, looking at stock consumption ratios against price, would come out with a fair value price of around about £2,000 per tonne, given our current supply-demand balance. So that comes back into the middle of that sustainable price range that we opened the presentation with, talking about the price at which the farmer is incentivized to increase his production. So at the moment, we are trading at a risk premium to that long-term fair value price, but with justifiable reasons, which we will discuss in a second. I think the other thing that we would like to make everybody clearly aware of is just how unusually tight the level of stock consumption ratio is. In Laurent's presentation, he showed stock consumption ratios really in a declining trend for the last 10 or 15 years. We are very, very close to the left-hand side of the chart, the point at which the stock consumption ratio starts to fall below 30%, even down to 25%. This is an unusual situation. In our 40-year annual history, we have only had stock consumption ratios at these kind of levels, perhaps in 4 occasions out of the 40 years. So there is a lot of risk, not only in terms of the balance sheet as we currently see it, which we will discuss on our final slide, but also simply from the fact that the stock consumption level is now at very historically tight levels. We are moving into that part of the history where there's a lot of uncertainty about the relationship between stock to grind and price. If we move on to the final slide, I'd like to finish just by giving a summary of the potential bullish and bearish changes. Starting on the bull side, it is incredibly dry at the moment in West Africa, unusually so, and as we've said, there is a clear risk that this dry weather results in further West African main crop deterioration. And we would note once again, whilst we are assuming effectively that the decrease in the Ivory Coast crop from trend is offset by the increase in Ghana, some analysts are already estimating combined main crops to be another 100,000 tonnes lower than our forecasts. The other major bull risk for West Africa is that Ghana production is indeed in structural decline. We are assuming the contrary unless proven otherwise, but of course there is the risk that Ghana production is unable to rebound in 2015-16. We would also point out the increasing risk that West African mid-crops could be below trend. We are assuming record crops combined between the Ivory Coast and Ghana. That is nothing to get excited about. When crops are getting bigger over time, you assume a record every season. But that puts a lot of risk into the weather and the harmattan conditions in December, January for the development of the 15-16 mid-crops. And finally, on the production side, the risk that Ecuador sees a 97-98 style El Nino related decline. Again, we don't think that is the most likely scenario, but frankly, until the crop is developed, harvested, it remains a significant risk. I'm sure other people will cover the Ivory Coast political situation, whilst we all hope for a very peaceful transition in the upcoming elections. That is always a risk, particularly just ahead of the Ivory Coast election. On the bear side, there is the, I would say, shrinking possibility that West African main crops improve. I wrote this presentation around 7 to 10 days ago, and since that time weather conditions have continued to be disappointing, I would say, and so the risk that the tail of that crop improves is probably diminishing. However, they may outperform the most extreme expectations. Ghana could rebound even more significantly than we assume, and the 2014-15 main crop could prove to be a clear anomaly. We may well see the big mid-crop trend proving itself out, and indeed record mid-crops. Finally, on the production side, it may be that many of the people in the room are right, and that Ecuador does not see the type of decline that we are assuming. As I said, our assumption would be that Ecuador production is in a strong uptrend. If that continues, if that proves itself, perhaps the deficit expectation will be less extreme than we're currently outlining. And finally, we've talked about the risk that grind continues to flatline as chocolate consumption is hit by high price and weak emerging market demand. So I think with all of that said, in a very short summary, we believe that in the medium term current prices are enough to encourage supply growth to avoid structural deficit. However, this is not a normal year. Weather has been very unusual, crops appear to have been affected, and we are making assumptions at the moment that crops are around 175,000 tonnes below trend. That puts the market into an expected deficit. We are by no means the most extreme deficit out there, and it puts us into a stock consumption point where we are at significant risk of seeing the tightest stock consumption levels in at least 10 to 15 years. So we may be trading at a small premium to fair value price, but there are an enormous number of risks out there, and hopefully many of the other speakers today will identify those. As Judith said, we would like to move things along, but I am happy to take any questions from any of you at any point during the day before I hand on to the next speaker. So thank you very much.